Hello, everybody. In this session, we are talking about financial statement analysis. Financial statement analysis is the process of analyzing a company's financial statements for decision making purposes. External stakeholders use it to understand the overall health of an organization and to evaluate financial performance and business value. Internal constituents use it as a monitoring tool for managing the finances. And then, why is analyzing financial statements important? Financial statement analysis offers a clear and comprehensive view of a company's financial health for both internal stakeholders, such as the finance team and business leaders, and external stakeholders, such as investors. This analysis helps holders identify key insights into a company's performance. It also keeps finance professionals and investors informed about business and market trends, enabling better decision making. In addition, evaluating key financial ratios such as profitability, liquidity, and solvency helps finance teams and business leaders assess resource management and progress toward financial goals. Investors also use ratio analysis to gauge a company's financial health and graph potential for informed investment decisions. And then we move to purpose of financial statement analysis. The objective is to thoroughly understand a company's financial performance and condition. By comprehending the financial statements, stakeholders can learn about the company's profitability, liquidity, solvency, and operational effectiveness. Take a retail company, for example. Financial analysis can help stakeholders evaluate its capacity to make money from sales, efficiently manage inventory turnover, and sustain a healthy cash flow to cover operating expenses. It is possible to compute ratios such as the return on assets and current ratio to assess the liquidity and profitability of the business. This research makes educated decisions about possible investment, credit decisions, or strategic planning easier by pointing out the company's financial structure, strengths, and shortcomings. And then we move to types of financial statement analysis. There are three types of financial statement analysis. The first type, vertical analysis. Vertical analysis is the process of examining relationships between different items on the same financial statement for the same period. The term vertical comes from the top to bottom, columnar layout of financial statements. An income statement, for example, lists revenue at the top, followed by expenses, gains and losses, and net income at the bottom. Gross margin percentage, which measures a company's profitability from its core business, is an example of vertical analysis because it divides gross profit by total revenue to line items on the same income statement. And then the second, horizontal analysis. Horizontal analysis involves comparing a piece of financial information over different accounting periods. Horizontal analysis makes it easy to see trends as the same data point changes over time. For example, comparing a company's total revenue for each quarter in a year would show whether sales are increasing, decreasing, or staying the same. This type of analysis reveals the direction and magnitude of changes over time and is useful for setting budgets, making projections, or preparing forecasts. Horizontal comparisons can be made for any line item or ratio from any financial statement. They can also include comparisons to budgets and forecasts, as well as historical accounting periods. In addition, horizontal analysis is often used to compare companies' performance to that of other companies in the same industry against industry benchmark. And then the third, ratio analysis. Ratios are calculations that show the relationships between two or more data points. Analysts use financial statement ratios because they are a fast, quantitative way to gain a lot of insight into complex business processes. And then we move to the key components of financial statements used in the analysis. First component, balance sheet. The balance sheet presents a snapshot of a company's financial position at a specific point in time. It outlines the company's assets, liabilities, and shareholders' equity, portraying the fundamental equation that assets equal liabilities plus equity. This component allows you to assess the company's solvency and financial stability. The proportion of current assets, current liabilities provides insight into short-term liquidity, while the overall structure of assets versus long-term debt reveals the company's financial structure. And then the second, income statement. The profit and loss income statement showcases a company's revenue, expenses, and net income over a defined period. You can evaluate the company's profitability and operational efficiency through this component. Key metrics like gross and net profit margin offer an understanding of the company's ability to generate profit from its operations. By comparing revenue growth to expense growth, you gauge the company's cost management and potential for sustainable earnings. And then third, cash flow statement. The cash flow statement tracks the inflows and outflows of cash within a company during a specified period. It is indispensable in assessing a company's ability to generate and manage cash. This statement is crucial for determining the company's liquidity and financial flexibility. Operating, investing, and financing activities are categorized, revealing whether the company generates enough operational cash flow to cover investments and debt obligations. By examining this statement, you can comprehend the company's ability to fund expansion, repay debt, and weather unforeseen financial challenges. I think it is enough of this session. Thanks for watching, and don't forget give this channel with your like, comment, subscribe, and share. Thank you.